Take a look at all of these logos on the screen. They're market data platforms, screeners, and research providers. And if you've ever tried to get a read on the overall market, you've probably at least used one of these websites. Ever since I could remember, I've been jumping between these websites to get a read on the markets, but I wanted something better. I wanted something all in one page. I wanted something more customizable. I wanted something that I could easily export and share with others. And I wanted something that went beyond simple market overviews and showed more of a trend over time. I also did not want to pay hundreds of dollars just to have access to a few data points. So what I did is I put together a dashboard, and it has everything I need all in one place, and it's fully customizable and free to use. You can upgrade if you want, if you like to customize the logos and the colors a bit more, but everything else is completely free to use. There are 3 columns here. You can pin columns and it'll stay sticky, or you can just unpin them and they won't stay sticky. You can also move panels to the right and left, up and down, wherever you like. You can also close them out and then re-add them here in this customized view option. Another thing you can do is resize the panels. So maybe the left side isn't as important to you and you want to focus more on this heat map. You can do that easily. Every single panel here also has these info pop-ups, and they give you an explanation of what exactly you're looking at and also how fresh the data is. There's a light mode and a dark mode, and you can also select a universal time period. So right now, everything is on the 3-month, but for this example, what we'll do is we'll change everything to the 1 month, and then all of these panels here update automatically. This main info pop-up tells you everything about the dashboard in more detail, including where the data sources are coming from. And then I also have the option to export anything. So you can export all of these panels. There's almost 20 of them here. It generates a preview so you can see exactly what it looks like, and then you can export it as a PNG and share it anywhere you like. And if you upgrade, you can customize the logo and then also the primary colors that are on the export itself. So that is a brief overview, but a lot of this, if you're looking at this for the first time, is a bit overwhelming, and you might not know how to really interpret some of these panels, such as Gabe's 4 quadrants or the growth and policy quadrant here. So what I'm going to do now is just turn everything off, and then we'll go through each panel one at a time and explain exactly what it is, why it's there, and how to read it. By the end of this video, you should be able to understand the entire thing, and you'll know exactly what to focus on when you want to get a read on the macro environment. So the first panel I want to show is the index snapshot. This one is pretty self-explanatory. It's just 4 cards, one for each major US index. So we have the S&P 500, the NASDAQ, the Dow, and the Russell 2000. Each of them shows where it's trading, how much it's moved over your selected period, which is 1 month, and a small chart of how it got there. Now moving on to the S&P 500 heat map. If you've used FinViz before, this will probably look familiar to you. Every box is one company in the S&P 500. So they're grouped by the 11 sectors, sized by market cap. So the bigger company takes up more space, and it's colored by performance, green for up, red for down. So what you get from this is the shape of a move, not just the direction. You can see instantly whether the market went up because everything went up, or because 3 large companies, because the S&P 500 is market cap weighted. You can also see whether it was a tech day or an energy day, and hovering on any box will show you the company, the ticker, its exact move, and its market cap. And the unique thing about this panel is that you can customize it. So click on this filter icon, and let's say you only want to look at the infotech sector. You would just unselect all of these. Then you can take a closer look at what is moving in the tech sector and a closer look at these names here. Before I lose your attention, the biggest panel that I want to focus on, and the reason I built this dashboard in the first place, is primarily for this metrics heat map. So this metrics table holds around 50 of the most important macro and market indicators sorted into 9 groups, which again, you can filter out if you don't want to look at them. The 9 groups are equities, breadth, sentiment and positioning, volatility, rates, credit, and liquidity, commodities, and foreign exchange, labor, and cross-asset regimes. So each row is one indicator. Reading across, you get its last 13 weeks, so you can see the trend and not just today's number. Then on the right side, you have the 5-year average, min and max, and a percentile column. This percentile column is one of the more important things in this table, and that's because a raw number by itself is fairly useless. It'll tell you the VIX is 18.6. Is that high? You will probably don't know what the answer to that is unless you're really familiar with the VIX or you have knowledge of its past trends. The percentile answer here tells you immediately because it shows you where today, meaning the close as of July 24th, sits inside that metric's own 5-year range. So every single single color here that you see is coded based off the percentile here. So anything sitting at an extreme is obvious without you having to read into a single number. One thing to mention is if a cell is blank here, that simply means that the source hasn't published that week yet. The table never fills a gap with last week's number and it never estimates. You get real reported data or nothing. If you ever wonder what a metric means, by the way, you can always hover over these names here and it'll give you a description of that. Another thing to mention is these checkboxes. You can select any of them up to 6 and it'll plot a chart for you. So you can actually get a better sense of the trend without having to just rely on a table. You can plot multiple over the same chart, plot bar charts, plot them as a stacked bar. You can plot them as a separate axis. And like the other panels, you can export these as well if you like. You can also tag the data, show 5-year average min and max. So it's a pretty customizable tool. And this is all based on the data from the metrics table. Now let me talk about each of the 9 categories more closely, starting with equities. Equities tells us how expensive the market is and what's actually driving it. So we have the S&P 500 drawdown from the 52-week high. It's just how far the index has fallen from its highest point in the past year. 0%, like it was a few weeks ago, just means we're at a new high. And the more negative it gets, the deeper the decline. I would read this compared to the VIX and the fear and greed reading further down. So I would compare this against the CNN fear and greed, and then also the volatility index, because the fear should be rising as the drawdown gets worse, or even sometimes as the market continues to climb higher. Next, we have the forward PE level and drawdown. So forward PE level is the S&P 500 price divided by the next 12 months of expected earnings. So it's what you're paying for $1 of future profit. I would compare this to the 5-year average to see whether the stocks are expensive or cheap by their own recent standard. Then compare it to the 10-year yield in the rates group further below here, because when yields go up, a lower PE is justified. The forward PE drawdown is just how far that multiple has fallen from its peak. This one is useful because a falling multiple has only 2 real possible causes. Either price has dropped or the earnings estimates went up. The next one is the implied equity risk premium, which is very useful for valuations. It's effectively the excess return you're being paid as an equity investor to own stocks instead of treasuries. A higher equity risk premium means the market is cheaper and you're being compensated well for the risk. A lower equity risk premium simply means investors are accepting very little extra return to own stocks. Forward EPS growth is the year-over-year change in what analysts expect the S&P 500 to earn. Rising means they're raising their estimates, falling means they're cutting. Earnings drive stock prices over any real length of time. So when this turns down while the market sits at highs, that's worth noticing. Then we have the EPS revision, and it's worth plotting these two because EPS revision is the same question on a 4-week time frame. So it moves faster and it's noisier. So you should use the two together because one gives you the direction of earnings and the other tells you how quickly it's changing. Next, we have the S&P 500 divided by gold prices. So this prices the stock market in gold instead of dollars. When it rises, stocks are gaining in real terms. When stocks are climbing, but this is falling, most of that gain is just the dollar losing value, not real growth in what your money can buy. The next one is the RSP over the SPY. RSP is simply the equal weighted S&P 500 to the normal one, which is market weighted, which really means the average stock versus the index. So if this is rising, that means the rally is broad and most stocks are participating. If it's falling, that means a few giant companies are carrying everything. Then we have the IWM over the SPY. So this is just small companies versus large ones. When it rises, investors are willing to own smaller and riskier businesses, which is a healthy sign. When it falls, money is said to be hiding in large, safe names. Next, we have XLY over XLP. So that's just the consumer discretionary versus consumer staples. Or in other words, the stuff people buy when they feel good versus the stuff they buy no matter what. If this is rising, that means the market expects people to keep spending. If it's falling, that means it's bracing for them to cut back. So you should read this next to the consumer sentiment and the retail sales numbers in the economic panel that I'll show you later on. Finally, we have the EM over the SPY. This is just the emerging markets versus the S&P 500. When it is rising, it usually means a weaker dollar and stronger global growth. When it falls, the US is leading. Now, the next group is breadth, which is about participation, and it exists because an index can rise while most of its stocks are falling. If you look at breadth, you can catch that early since it usually weakens before the index does. So the first two are similar. The first one tells you what share of stocks are trading above their own average price over the last 50 days. Over 70 effectively means a broad, healthy advance. Below 30 means most stocks are already falling regardless of what the index says. Then we have percent above the 200-day average, the same idea on a much longer trend. Above 80 is a strong bull market. Below 40 is a broad bear market. The thing to watch for is the index making new highs while this number drops. That means fewer and fewer stocks are doing the work, and that's how tops tend to form. Then we have new 52-week highs and lows. 52-week highs just counts how many stocks in the index hit a one-year high. 50 or more means real participation. A rally with almost no new highs is being carried by a very small group of stocks. Then we have new 52-week lows is the opposite count, and it's a distress signal. This will spike during genuine corrections. I would weight the new 52-week lows against the high-yield credit spreads because broad damage should show up in both places at once. You can also look at net new 52-week highs. It's just the highs minus the lows in a single number. Positive simply means more winners than casualties. And when this turns negative while the index is still near a high, that means that the inside of the market is breaking down before the outside does. The next metric I want to talk about is stage 2 minus stage 4. That comes from a technique called stage analysis. So a stock that is trading below a falling average is declining. So this row subtracts the percentage declining from the percentage advancing, so you get one number for how many stocks are in genuine uptrends versus genuine downtrends. The next group is sentiment and positioning. So this covers what investors are feeling and, more importantly, what they've actually done with their money. It matters most at the extremes because that's when things tend to snap back. The CNN fear and greed you've probably seen before. It's their own measure that blends 7 different market signals into one score from 0 to 100. Lower means more fear. So under 25 is extreme fear, which has historically been a decent time to buy. Over 75 is extreme greed, which has historically been a decent time to trim or consider potentially selling. The next 4 are from the CFTC. These all come from the same report. So every week, the CFTC, which is a government regulator, publishes how speculators are positioned in the futures market. That's hedge funds and large traders. So a positive number means they're collectively betting the price goes up. Negative means they're betting it goes down. The reason this is worth tracking is that when everybody has already placed the same bet, there's nobody left to place it again. And unwinding a crowded position is what can produce sudden reversals. Starting with the S&P 500 speculative positioning, it shows this for stock futures. The extremes are what matter here, and heavy net shorts near a market low have historically marked bottoms because every one of those shorts eventually has to buy. Then we have the 10-year treasury positioning, which shows it for bonds. Crowded bets against bonds have often appeared right before the Fed pivots and bonds rally, so you should read this chart against the 10-year yield, which is right here in the rates. Then we have the gold positioning, and this captures the speculative demand for gold separately from people buying the physical metal. Overcrowded bets tend to show up near short-term tops and bottoms. Next, we have the WTI positioning, which is the same thing but just for oil. Heavy bets on higher prices means real downside risk if demand disappoints, and heavy bets against oil are rare and usually happen near cyclical lows. Moving on from CFTC, we have the S&P 500 high beta divided by the S&P 500 low volatility. This one compares the most volatile stocks in the S&P 500 to the calmest ones, and it's one of my favorite reads on risk appetite because rising means investors are reaching for more aggressive names and falling means they're rotating into safety even if the index looks fine. Now let's move on to the volatility category, and these 4 come from the options market, which is where people pay real money to protect themselves. So that makes them a good measure of how nervous the market actually is, rather than how nervous it says it is. The fix we touched on before, it's how much the market expects the S&P 500 to swing over the next 30 days. So below 15 is calm, 15 to 20 is relatively normal, and above 25 means real fear is being priced in. We also have the MOVE index. This is the same concept, but for treasuries. So it's the bonds market version of the VIX. It's worth watching because bond markets often get nervous first before equity markets. When the MOVE jumps and the VIX hasn't moved, the VIX is usually about to catch up. Next, we have the VIX divided by the VIX 3-month. This compares the cost of protection over the next month to protection over the next 3 months. Normally, the near term is cheaper, so this sits below 1.0. When it goes above 1, that means that people are paying more to be protected right now than later, which is what you'd expect in a very fearful market. Lastly, we have skew, and it measures what traders are paying specifically for crash protection, meaning options that only pay off in a severe drop. The useful part is that the skew can be high while the VIX is low, which you could consider to be a calm market with expensive insurance underneath. Readings above 150 have historically come before sharp declines. Now let's move on to rates, and interest rates set the price of every other asset, so this group matters even if you never bought a bond in your life. Most of these are pretty self-explanatory, but starting from the top, we have the 3-month T-bill rate. This tracks the Fed's policy rate almost exactly. When it falls, the market is betting on rate cuts. Everything else in this group moves relative to the 3-month T-bill. The 2-year yield is the most sensitive to what the Fed does next, so it tells you where the market thinks policy is headed over the next couple of years. Then we have the 10-year nominal rate, and that's basically the benchmark for everything. We have mortgages, corporate borrowing, and if you're doing stock valuations, that also gets priced off of it. Rising 10-year yields push stock multiples down, and falling yields lift them, which is why you should check the 10-year yield against the forward PE and the implied equity risk premium. The 30-year yield reflects long-run inflation and how much the government needs to borrow. So when it rises while the Fed is cutting rates, the bond market is telling you it's worried about inflation or deficits. Then we have the 10-year tips. This is considered to be the real yield, while this is the nominal one. That basically just means what a treasury pays you after inflation. So it's the honest measure of how tight money actually is, and it's also the number that drives gold, because gold doesn't pay you anything. When real yields rise, holding gold costs you more. Then we have the 10-year break-even. So this is the bonds market forecast for average inflation over the next decade, and is backed by people's actual money rather than a survey. So what I would do is I would compare this yield to the CPI numbers and the economic panel, and then also to oil, since energy feeds straight into inflation expectations. Then we have the 10-year minus the 2-year. This is also just known as the yield curve, or at least the most conventional version of the yield curve. It's also the most famous recession indicator there is. When it is negative, meaning the short-term rates are higher than the long-term rates, the yield is considered inverted, and a prolonged inverted yield curve has come before every US recession since the 1970s. The 2-year rate minus the federal funds rate takes the market's rate forecast and puts it in one number. If it's negative, that means cuts are priced in. Positive means hikes, and the size roughly scales with how many. Moving on to credit and liquidity. Credit is usually where the stress appears first. You can start by looking at the investment grade spreads. So this measures the extra yield investors demand to lend to solid companies instead of the government in basis points, and 100 basis points means 1%. The wider it is, the more concern about companies covering their debts. The tighter it is, the more confidence investors have. We also have the high yield spreads. Those are the same thing, except for riskier, what's considered to be junk rated companies. This is the most sensitive stress gauge possibly in this entire table, because it is often widened days or weeks before stocks have fallen. And if this is climbing, then that could indicate that stocks will be selling off in the near future. Then we have the Chicago Fed NFCI. It's the National Financial Conditions Index. And what this index does is it condenses more than 100 measures of US financial conditions into one number. If it is negative, as it has been, that means that conditions are loose and money is cheap. Positive means things are tight and there's more stress in the system. Lastly, we have net liquidity, and this is year over year. So this tracks how many dollars the Fed system is actually adding to or pulling out of the markets, which is the Fed's balance sheet minus money parked back at the Fed minus the Treasury's cash account. The reason you look at this is because expanding liquidity has generally been good for stocks, and shrinking liquidity has been a headwind. Moving on, we have the commodities and forex category. The fact is that commodities and the dollar move on real supply and demand, so they often pick up on inflation and growth before stocks do. Starting with the dollar index, this just measures the dollar against a basket of major trading partners. A strong dollar squeezes emerging markets and hurts US companies that sell overseas. A weak dollar lifts commodity prices and boosts multinational earnings. Then we have the WTI crude, which is just oil. The useful question with oil is always whether it is rising from strong demand, which is good, or a supply problem, which is bad. We also have gold. So gold is just a classic safe haven and what some investors consider as an inflation hedge. The signal to watch is whether gold is rising at the same time as stocks, which usually means there's inflation anxiety underneath the rally. Its main driver is the real yield that we covered in the rates group. Then we have the price of copper, and it gets called Dr. Copper because it's wiring, construction, and machinery everywhere on Earth. So it reads global industrial demand in real time, especially from China. Rising copper means the economy is running warm. We also have copper divided by gold. It puts the growth and fear in a single ratio since it's the industrial metal over the safety metal. If it's rising as it is right now, that means optimism about growth. And then if it's falling, that means concern. It also tends to track the 10-year yield closely. Lastly, we have gold over silver, which just measures the stress inside precious metals because gold is purely a safe haven while silver is half industrial. So when the ratio is climbing, people specifically want safety, and when it falls, risk appetite is coming back. Then we have labor, which is only one metric. We have initial jobs claims. So this counts the new filings for unemployment benefits averaged over 4 weeks to smooth out the noise. So this measure gets reported weekly when almost everything else about employment is monthly and gets revised later. And historically, if this has been above 300,000, it's signaled a recession. You should read this alongside the yield curve because if the job market is cracking while the curve turns positive, that's the classic recession sequence, and it's the combination I'd want to see before taking a recession call more seriously. And finally, we have the last two metrics. So we have stocks versus the long-term treasuries and the correlation between the two. So this measures whether they move together over the last 13 weeks. Negative is the normal healthy setup where stocks fall and bonds rise to cushion you. That's the entire traditional premise of a balanced portfolio. When it goes positive, stocks and bonds are dropping together. So that means that your bonds have theoretically stopped protecting you. And that's what an inflation-driven market feels like. And then we have the gold versus the long-term treasuries correlation. And this tells you which safe haven is actually working. So when this is positive, it means bonds have stopped hedging. Then you should watch whether the gold breaks away from there. If it does, then gold has taken over the job bonds used to do. And that's the entire metrics table in a nutshell. Some are obviously more useful than others. What I would do is I would just scan the last column, look at the percentile, and then also just look at the colors. It'll give you a quick read in a few minutes. The next chart I want to highlight is the sector performance. So this breaks the market into its 11 sectors, and then it ranks them over your selected period, which is 1 month. What you're looking for here is rotation, meaning where money is moving. So when investors feel good, the aggressive sectors lead. So technology, for example, when they get nervous, it flips to sectors like healthcare and consumer staples and utilities because people keep buying toothpaste and electricity in a recession. So you can compare any of these sectors against the overall market, and you can either eyeball it or you can just use this table and it'll tell you the exact performance. And now I want to focus on one of the most useful panels, which is the growth and policy one. So this is considered to be a regime map. The idea behind it is that markets behave completely differently depending on two things. The first is whether the economy is speeding up or slowing down, and the second is whether the Fed is making money cheaper or more expensive. And then if you cross those two, you get 4 possible quadrants. So you have risk on, soft landing, recession risk, and then late cycle. The dot shows where we are now. You can also see the 13-week history. So this shows the path that the market took to get to where we are today. And that direction matters as much as the current position because growth slowing while the Fed is still tight is a completely different environment than growth recovering while the Fed is cutting. Even if the dot is in the same box, what matters is the direction, not just where it is in the box. So you can see, and each of these boxes, if you hover over them, give you a description of what each of the quadrants mean, and it suggests what you should be longing and shorting based on the macro environment. Another regime that you can look at is Charles Gave's 4 quadrants. So this regime map plots growth against inflation instead. So you end up in an inflationary boom, inflationary bust, a deflationary bust, or a deflationary boom. Each of those rewards a different set of assets, which is the entire reason to know where you are. And here it suggests we should long or short, just like the other regime quadrant, based on where we are today. You'll notice that this quadrant chart also comes with 3 charts that are shown below here. So the first one is stocks versus oil, and then we have gold versus bonds, each of them with a 7-year moving average. So you can see when a relationship has stretched too far. So these 2 charts determine where the chart gets plotted. So right now the dot is plotted in an inflationary boom because, as it says here in the info box, when stocks versus oil is higher than a 7-year average, it's considered a boom. And then for the second one, when gold is outpacing bonds, it's considered to be in an inflationary regime, which means it's in the top of the quadrant. And then the last chart is just the market over gold, which shows whether equity gains are real or just because of a weaker dollar. This panel gives you an overall interpretation of the market. So you have 4 different inflation indicators here with descriptions, and there are 5-year monthly charts shown on the hover. We have more data on labor, including payrolls and the SAM roll. It's basically just a recession indicator based on how fast unemployment is climbing. Then we have the consumer, meaning sentiment and retail sales. Then we have real activity, which is industrial production and housing starts. Then we have leading indicators. So we have the ISM survey and the regional Fed surveys. Then we have valuation and monetary, which covers the Shiller-Kate ratio, the Buffett indicator, and then the growth in the M2 money supply. So every card shows the latest reading and the date it came out, so you always know how fresh it is, and everything else you can read in the description if you wanted to learn more about what each indicator tells you. Then we have the economic calendar, which is self-explanatory. This is telling you what is coming out. So we have the next Fed decision, the GDP, the jobs report, inflation. It's all dated in terms of when exactly it is expected to be reported. You can click on any of these links and it'll direct you to that exact source where you can learn more. Also, I have the different events flagged by how important or market moving each release is. So we have the red as high, so things like inflation, jobs. Then we have medium, which is things like retail sales. And then we have low, which are sentiment surveys, which don't really cause a huge move in the markets. Moving on, we have fixed income, and you'll see several panels that look like this one here. This one covers the bonds market's actual returns grouped by type, treasuries by maturity, government and agency debt, investment grade credit, high yield credit, and international. You also get a description of each one if you hover over any of the cells. By the way, on any of the panels that look like this one, you can change it to be a vertical stack instead. You select this stack icon here and it'll turn into a vertically stacked view, which is better for keeping on the left or right side column in a more condensed format. The next panel I want to show you is the currency performance, and then also with that I want to show you the currencies table. So these two go together. Currency performance is a grid of 10 major currencies against each other, so the dollar, euro, pound, yen, franc, and the rest. Every pair in one place, color coded by strength. You can read it across any row to see one currency against all of the others. You can either show a static view, or what I like to do is I like to sort it so that it ranks it from highest to lowest. So that's more useful than a single dollar index because it tells you whether a strong dollar is actually really about the dollar or about one specific currency falling apart. The currency panel here gives you similar information just in a different view, and it also provides a 52-week range as well. We also have a similar situation for commodities and commodity performance. Commodity performance covers energy, metals, agriculture, and the broad indices. Then the commodity table here gives you the prices themselves. So we already saw gold, oil, and copper on a week-over-week basis in our metrics table. This just gives you that and a lot more. And by the way, on these tables, you can filter out any of the categories that you don't want to see pretty simply. Then let's talk about the global equity indexes as well as the country ETFs. These two zoom out to the rest of the world outside of the US. So first by region and then country by country across the Americas, Europe, Asia Pacific, and the Middle East and Africa. This answers whether the US is leading or lagging anyone else. The next panel is is the thematic trends. It's a map of different themes that the market is investing in. So we have cybersecurity, defense, gold, miners, China, internet, Bitcoin, and more. It shows you which stories the market is actually paying for right now, which is often not the same as the stories getting the most attention. Two more that are similar are the factors performance and the size versus value. So this looks at investing style, and we have value versus growth, momentum, low volatility, quality, dividend payers. And then we have the classic grid style of company size against value and growth. And for both of these, you can look at it on an absolute basis, or you can compare it versus the overall market over any of these periods. So if you have ever wondered whether value is finally working or whether small caps are leading, then these panels will help answer that. That's the entire macro dashboard. Again, the great thing about this is that you can customize anything, and you can export everything as an image, and you can filter many of these panels down even further using these filter icons, and you can configure this however you want, and it'll load exactly how you left it. If you have any suggestions on what you like added, just let me know. But that's about it. First link in the description will be the link to where you can access this dashboard and customize it and make it your own.